Good morning, and we're live today to talk to you about what questions you should be asking your accountant in your monthly reviews or quarterly reviews if you don't talk to your accountant on a monthly basis. So this is a question that we often get asked by our own clients is what should we be asking you? What should we be talking about each month? And what should we be looking at? So let's assume that we've already had those discussions on, whether you're on the right business model, what your income targets are for this week or for this year or for this month, whatever. What we're looking at today is quite simply what you should be looking at each month or each quarter with your accountant. So this is an accounts review. So let's just switch over to Xero. So we're using Xero as our demonstration for today, but it could be any accounting software that you might use. So typically we would look through our profit and loss account and our balance sheet with our clients. So we're going to start with the P&L at the moment. Now, the first question, if you just highlight that, Harry, over here, is usually, am I making a profit? So we will have done all the accounting adjustments in the background. We would have accrued and deferred income and costs into the right bucket. And so we should be looking at whether we are making a profit. So I think if you just pop up to the top for a second, Harry, what we've got here is a part month for February. So let's go to compare periods and look at January, which will be our last completed month, and the previous 3 periods. So always ignore the current month that you're partway through because it won't have the full picture. You need to be looking at the last full month completed. So the first thing we should be looking at is whether we are making a profit. So we're looking at the operating profit rather than the net profit at the moment. So this is our earnings before we've looked at corporation tax or dividends or anything like this. So this is what we are likely to be paying tax on in our business. And once we know whether or not we're making a profit for the whole business, we tend to then go backwards and look at question number 2, which is, are my sales on target? So understanding where you end up first is often more helpful to understand whether your sales and your costs and the rest of your trading activity is in the right place. So we look at operating profit first to see whether we're on track. Quite often we'll have a budget or a target that we'll be comparing against, not for the purpose of this demo, but we would normally look at that with each of our clients. So let's go back and have a look at our sales and our purchases. So are the sales on track? Are they right compared to budget? Are they looking accurate month on month? Have we got big trends? So you can see here that October was pretty slow, and we've built up November, December and January. So if this were a typical client, we'd be looking at what drove those sales. How did you achieve those sales in January 2020? Is that indicative of the new types of activity that we're looking at? Is this the normal kind of sales activity? Does this relate to sales that are relating to January only, or should they be deferred? Are they February sales actually just billed early in January, or perhaps they're December sales booked late and they should have been deferred back to December? So we'll try to understand why the sales have grown or fallen to the level that they have. And if we've done something really positive, so say this is a new initiative and we've achieved some new sales activity, we'd be looking at what happened, why did those sales increase, what can we do to increase that behaviour, to do more of that behaviour, how can we get more of those sales? And there's a lot of questions around how we've achieved those kind of sales figures in that month and whether we can sustain them.
And that's the thing, though. It's not just about the negatives. You're not looking and go, oh, am I under budget? You're looking at saying, what did I do right? Okay, in January, I did this right. I brought out this level of sales and I brought out this new product. And look at the result. I've massively increased my sales. And actually, they only have a small cost to them. So it's about looking at the positives on this side as well. And yeah, not just the negatives, basically.
Yeah, absolutely. So in this instance, we can see that we had all of these sales and, for example, we had a massive amount of sales activity in marketing. So we had some spend activity. So first we would look at, are we making a profit? Second, we'll look to see if our sales are on target and what's going well and what's not going well. Third, we're going to look at our costs. So in this month for this client, we've had £7,500 or £7,000 worth of additional costs in our advertising and marketing. So that probably drove those sales. So then we'd be looking at, is that normal? Was that a one-off? Did that sales activity drive all of those sales in January 2020? And is that what it's going to cost us to get those kind of sales for the following month? So then we'd be starting to look down the rest of our P&L, and are our costs controlled? So this is a demo client, so it's not a particularly good example, but you'd expect to have accountancy fees and bank fees and general expenses, regular costs going through the business. We can see that in December 2019 there was a big subscription for £1,219. Now that probably is an annual subscription which we should be sharing and deferring, prepaying across the next year. So that would be something that we would do in the background to make sure our costs are smooth. So the cash might have gone out now for that subscription, but actually the cost relates to the next year because you're subscribed to something that would give you a year's worth of benefit. Looking down a little further, we can see that our rental costs and our office repairs are pretty much on a par month by month. We've got a little extra heat, light and power cost. We've got a little extra repairs and maintenance in December, and that's fine. That's quite normal. What you would look at in December is whether that 886 was really repairs and maintenance, or was it perhaps a leasehold improvement. If it's under £1,000, generally it's a repair and maintenance, so perhaps that's in the right place. So we continue down the P&L to see whether our costs are all controlled, and they do look fine. Now, what is interesting is that despite having that massive spike in sales in January, if you look at our operating profit, we're only up by a couple of £100, and only £150 month on month. So although we had that huge spike, and it might have been a lot more effort and a lot more activity going on, it didn't really deliver us much of a result on our bottom line. So that's what we would have a look at. Is that really the right activity? How could we have made those sales but not incurred so much cost? Are there other costs in there that we need to think about? This month on month, remember, is slightly skewed because we've got £1,200 worth of subscription costs in there. But those are the kind of things that we should be looking at, and the questions that should be asking our accountant at the end of each month. So are our costs under control, and are they where we expect them to be?
And one thing with cost is, I would say, if you do have a Xero account as an example, if you can format the P&L, I would recommend using account groupings. It makes it so much easier to see what is going on with your costs.
Yeah, absolutely.
And as an example here, your eye's drawn to months where you've got these big peaks, like in premises expenses. Even though most of this is quite consistent, you get these one-off peaks. So it stands out much more clearly than just looking at individual account codes.
Yeah, and then if you have big peaks and troughs in things like advertising and marketing, which do tend to be related to the volume of sales you've got, it's easier to spot than if this was just in one standard list format. So that's one of the biggest challenges we see, clients trying to understand how their business is operating and how their business works when they don't have a P&L that's structured in a way that's going to help them understand how their business operates. So Harry's quite right. You'd expect things like office costs and premises costs to be fairly static and fairly similar month on month, but you might expect things like advertising and, say you were launching a new product and you had to have some legal advice, you'd expect these kind of costs to peak and trough as your sales activity moves. Now, next on our list that we would look at on a monthly basis, the question that you need to ask your accountant is, what's my corporation tax liability? Now, in today's age where we have profit and loss accounts in the systems, we're able to see our activity on a month by month basis. You can almost have a profit and loss on the first of the month following the last month of activity, if you keep up to date with your accounts and if you're posting all your transactions. So there's no reason why we can't, and we absolutely should be, accruing our corporation tax liability. So if we took 19% of our profits, and you can see in October, even if we make a loss, we should be putting a provision in for the negative corporation tax, the reduction in corporation tax that loss has added to our overall annual tax bill. If we can do this on a monthly basis, we'll know before we get to the end of the year what our tax bill is likely to be. So on an operating profit, which is our profit before tax and before our dividends, in an operating profit of around £10,100 in our year to date, we should have a corporation tax liability of about £2,700. We should know what that is, and we should be having that saved in our balance sheet. We should be saving it in our bank accounts, have a separate bank account set up so you can push your corporation tax cash into there. And then if you're clever with the way you name your accounts in your Xero or your QuickBooks account, you can see here that we've called this account corporation tax for the year 1920, but it's due on the 31st of December 2020. So we keep it really clear and really obvious. And if Harry, if you just pop back into the dashboard, we've got this particular account code flagged in our watch list so that when you go straight into your Xero account, you can see that your corporation tax bill is accumulating as we progress through the year, and it's due for payment on the 31st of December 2020, so we can put that cash aside, and that cash liability, that tax liability, is always front of mind.
And it's really helpful to have these accounts named based on due date and based on tax year.
Yeah,
because
absolutely.
then you can isolate each liability, so otherwise you just get single corporation tax due, and if you cross over into a financial year, you basically get a skewed result where it looks actually like you've got to pay, say, £4,000 when actually
But you
only
haven't,
£2,700
yeah.
for this year. The other £1,300 you don't need to think about for another 12 months.
Yeah.
So really, really key to get those separated out. It makes it so much clearer to see what's going on.
Yeah, so if we were sitting here in December 2019, we would have two account codes. You wouldn't see two account codes down here in the P&L, but you would see two corporation tax account codes here in your watch list, because one will be the provision from your year ending March 2019, say, due on the 31st December 2019, and this one that Harry's looking at here is for the current year accounts that we haven't completed yet and we haven't submitted the tax return yet. So one's a provision and one's crystallised. Now, the question we should then be asking is, do I have enough cash to cover my tax? So we know our tax liability is 2,788. At this point in time, we should have already paid our previous year's taxes. So this demo company has a year end of 31st of March. We would have paid 2019 March tax in 2019 December. So that's done and dusted, thankfully. So let's just have a quick look at our bank account. We can see here our statement balance is 17,000. So plenty there that we should, plenty there of cash that we have if we keep an eye on it. Now, the habit of the entrepreneur is to see that cash and to spend that cash. So what we would recommend doing is using this dormant business savings account that we have just below. This company has a savings account, it's not using it, so push that tax money over into a savings account so that you don't touch it, so that you're less tempted to touch it. So always move your VAT money aside and your corporation tax money aside to make sure that you don't accidentally spend any of that. It doesn't belong to you. Think of it as HMRC's money that you're just holding for them on account. Pop it into a savings account and don't touch it.
And the harder it is to spend, the less likely you are to spend it, basically.
Yeah, absolutely.
And it's easier to monitor if you can separate it into business bank accounts. It's so much easier to see what's going on because you know, for one fact, it's covered, and then for the other fact, you know that these funds are basically working capital. You can start spending them and start using them to pay suppliers, etc. So if you've got them isolated, it's much lower risk for you to manage.
Yeah. Now, the other thing you could do, we do have some clients who like to keep all of their taxes in one account, but I personally prefer to keep taxes in separate accounts. Now, corporation tax you have to physically pay by BACS, but VAT you can pay by direct debit. So if you had PAYE, VAT and corporation tax all ring-fenced in separate bank accounts, you can have those payments coming from or being paid from those separate accounts, and once it's out of your main account, it's, from your perspective, you need to think of that as done and dusted. It's over, you can't touch that anymore, but HMRC is covered. Now, the HMRC are probably one of the most important creditors to pay, because they're the ones that have the power to shut your business down if you don't keep on top of your taxes. So always put the money aside and don't spend it.
Because at most, a supplier might just delay their delivery of the service or goods to you. But HMRC can physically shut down the business if they really wanted to.
Yeah, it's so good of a supplier if they really wanted to, but let's hope it doesn't ever get to that. So let's pop back into our P&L. Now, one of the other things, so we've looked at corporation tax liabilities and do we have enough cash to cover our taxes? So hopefully the question for those is all yes. Finally, another tax question, question number 6 is, am I tax efficient? So you should be asking your accountant each month where there are efficiencies in tax. So at this point in time, February, now is a good time to be talking to your accountant about how to reduce your corporation tax bill if you're coming towards the end of the year. So if you know you want to spend money on training, or you know you've got to buy some new assets, spend the money now on those purchases so that it reduces your end of year tax bill, which is only 6 weeks away by now, 5-6 weeks away. Don't leave it until the following tax year to do that. Now, if you haven't got to spend the money, it is a false economy to spend £1 to save 20 pence. It's just not worth doing that. But if you have got things that you do want to buy, think about spending that money in this tax year.
Yeah, and it's exactly that. I think whenever you say, oh, we should be more tax efficient, I think people, their eyes light up and they think, if I spend this, I save massive amounts. But the reality is, as he says, you save about 20 pence in every pound, but you have to have the cash available to spend that pound in the first place. So just remember that it's basically reducing your cost to 80p, but actually the reality is you still have to spend out the cash anyway.
But what we should also be looking at here is, have we covered all of our personal expenses? So what about things that we've bought personally for the business? Have we made those provisions and put them through the business? Have we claimed our work from home allowance? Have we claimed all of our mileage? So these are all of the costs that should go through the business that you might not have spent from the business, but help make you more tax efficient. Mm-hmm. So think about those things. Also, if you are a development company, think about things like R&D tax credits, and are you entitled to claim tax credits back if you are developing software? And I'm not going to go into that in huge amounts of detail, but ask your questions to your client about whether you are tax efficient and how you can be more tax efficient.
And point number 7, I got a little bit ahead of myself because actually some of it does interlink with this one. Point number 7 is whether or not your director's loan account is covered. Now, the reason I opened it up a little bit early is because Lisa mentioned home expenses and various expenses as well.
Which reduce your director's loan account if you haven't drawn the cash out, but equally helps with tax efficiency. And so does a director's payroll. So director's payroll is not, if you see, in this particular business, and director's payroll could be put through the business to help reduce the corporation tax payable by the business, but reduce the amount that the director has drawn under their DLA.
Exactly.
So here, our director has taken out £6,500 worth of equivalent dividends in our year to date. Now, dividends are a funny one. So when you take cash out of your business, you take cash out and you treat it as if it's a loan to the company until such time as a dividend is declared. Now, if you take all of that money out into your business and have it all tracked in your director's loan account, it's harder to see whether you've taken more or less than your business can afford. So talk to your accountant about whether or not it is more appropriate and more helpful for you to see these pre-dividends in a way, because they're not really dividends because they haven't been declared, but they're the equivalent of dividends taken in lieu of declaring a dividend. So if you take fixed amounts each month, if the amount is fairly static, then one of the things that we like to do is show that sort of pre-dividend, dividend in lieu, at the bottom of the P&L. And what this really does is highlights quite blatantly whether you've taken more or less than the business can afford. So in this instance, this business has made £10,000 operating profit. It's got £2,700 worth of corporation tax liability, but the director has only taken £6,500 of dividends or pre-dividends. So this is fine because there's still a little bit of excess capacity in the business of £858 in that tax year. So the thing that's really important to remember when you're running a small business and it's a limited company is that dividends must be declared out of after-tax profits, which is another reason why it's so helpful to see dividends taken here in the P&L. Now, when you present your statutory accounts and your accountant does your end of year, you won't see dividends within your P&L, and they're certainly not a tax deductible expense. So one common error we see in sets of accounts is for corporation tax and dividends not to be shown at the bottom here as non-operating expenses where we have them, but to be shown over in the overheads, which is absolutely wrong because they are not overheads. They are non-operating expenses that are effectively below the line in the profit and loss.
And the problem with that is if you do have dividends within your operating expenses, but you have your corporation tax below the line, the temptation is to base your corporation tax on your operating profit, which has already factored the dividends in. So all of a sudden, your corporation tax is massively understated. And also, it's harder to see whether or not you've actually overdrawn, because not only is your provision too low, but you can't actually see the underlying result. So definitely do isolate these down below your operating profit. And all I've done is gone into the Xero's P&L, gone into layout options, edited, and literally just moved the accounts right down to the bottom where non-operating expenses are.
Okay, so just another point on the director's loan account. So in this layout, we've put our DLA and our dividends down in the bottom here of our P&L. Let's actually have a look at the balance sheet and see what the director's loan account is looking like for this instance. So we're just going to pop into the old format of the balance sheet because we prefer that.
It's just a little bit cleaner.
And if the director owed the business money and had an overdrawn director's loan account, you'd see that in the assets list. Unfortunately, it's not there, which is great. What we do have is our director's loan showing down here as a director's liability. So here, the company owes the director $4,130. So it's quite possible that at this point in time, the business owner had put cash in the business to start it up, and that capital helped with the running costs, but the business still owes the director that money. So the director has drawn £6,500 in dividends, which will be taxed as dividends, or everything over £2,000 would, but we could take £4,000 of that, and instead of treating it as a dividend, we could use that £4,000 and take it out and offset it against the director's loan account. So the cash was put in by the director to help the business run, and that was tax-free when it was put in the business, and it can be drawn out of the business tax-free without having to declare it as a dividend. So it's always super important to look at the amount of cash that you're drawing from your business and the impact that has on your director's loan account. So is it reducing cash that you put in the business, or is it creating a liability that you have to cover by declaring a dividend? And if you don't have enough after-tax profit to declare that dividend and set off that director's loan account, does that put you into an overdrawn director's loan situation?
Now, another point on the director's loan account here, which is really important in my opinion, is basically we mentioned at the start, if it's a current asset, then all of a sudden the business is owed money to buy the director, you're overdrawn. If it's a current liability, then the company owes you. The one thing I will point out is sometimes you see director's loan account grouped in current liabilities anyway, but actually this is a negative amount. So when you see that, it actually means it's a negative liability, which means it's an asset and the company is owed money by the director, so you're overdrawn. So if your director's loan account is grouped down in current liabilities, just keep an eye out to make sure this is not a negative, and if it is,
then it's an asset.
Then yes.
And the one thing that this older report in Xero can't do is it can't auto switch between an asset and a liability based on the sign or whether it's a debit or a credit in the balance sheet. The new reports do that, but personally I still think I'm a bit old school and I prefer these reports in Xero, the old reports in Xero, because I just think they're neater, they're more concise, and you can see more on a page.
Yeah.
Whereas the newer reports are a bit more fussy, they're a bit bigger, the text is bigger, and if that's right for you, then that's great, and you can then put dynamic rules in. But we still, a bit old school, we still prefer these old-fashioned reports. So those are the 7 questions that you should be asking your accountant on a monthly basis. Are you making a profit? Are your sales on target? Do you actually have a sales target? In which case, if you don't, I strongly recommend you get them. You really need an idea of what you're aiming for and what your end result needs to be in order to have a productive conversation with your accountant. So it's no good getting to the end of the year and saying, well, this is great, I made £50,000 profit, if you actually needed £80,000 of profit in order to cover your bills. So have a clear idea of what your targets are and talk to your accountant each month or each quarter about your progress against them. Are your sales on target? Are your costs controlled? Is your corporation tax liability accounted for, provided for, and do you have the cash to cover it? Do you have everything claimed that you should be, and are you tax efficient in your business? Are you running a director's payroll? Are you claiming everything that you should to keep your director's loan account covered? And what is your director's loan account impact on the end of year accounts? So that's it from us today. Do add any comments. Let us know if you've enjoyed this video, if you found it helpful. And please, we've got a couple of hearts already. That's fantastic. Thank you very much. So if you enjoyed it, please give us some hearts. Send us some love. I watch this in videos and I hate seeing that and I hate asking for it. But if you don't ask, you don't get, do you? So if you've enjoyed the video, please let us know. And we'll see you again tomorrow, probably.
Yep, we will do.
Right, speak to you soon.
Bye.
Bye for now.